Hello, this is Bill Scheid from Applied Finance Research with a summary overview of backtest results for several different configurations of our monthly asset allocation systems. What I want to stress here is that the systems that we're looking at are examples of configurations of monthly asset allocation systems that I personally trade, but these are by no means the only configurations of these systems, and they're certainly not the only results that are possible. I built these particular configurations of the monthly asset allocation systems to meet my personal trading objectives, but the monthly asset allocation systems we teach are highly flexible and can be easily customized by each individual trader or investor so that they meet your objectives. Yes, we do cover these specific configurations of the systems in our courses, but more importantly, we teach students how they can modify and build their own configurations. So in our courses, we give you some example fishes, and we also teach you how to fish for yourself. So what we're looking at here are backtest data as generated by etfreplay.com and Excel analysis. And this goes from December 31st of 2007 through 2023. So we have the great financial crisis, we have the COVID crash, we have everything in between. So starting with the column furthest on the left, here we have the S&P buy and hold data. And we're going to use this as a benchmark. So we can see that the total return was 323%, maximum drawdown of minus 52.3, compounded annual growth rate 9.5, return to drawdown ratio of 6.2, and the ending balance. So here, this is the ending balance of a hypothetical account, and we assume the starting balance is 100,000. We assume it grows at the compounded annual growth rate given here, so that would be 9.5%. And we assume it grows for 16 years. In other words, the end of 2007 through the end of 2023, and this is the hypothetical ending balance. The next column over, this is another possible benchmark we could use. This is an all-world 60/40 stock bond portfolio as created by etfreplay.com. This may be a bit more realistic of the buy and hold returns achieved by the general retail investing public. If you're paying a financial advisor to manage your money, they're probably not putting you 100% into the S&P 500. They're probably putting you into some kind of diversified stock bond mix like this. So here we see we have a total return of 116.9% on a maximum drawdown of 34.7, compounded annual growth rate 5.1, and a return to drawdown ratio of 3.4. So we've got a reduced drawdown, but also a reduced return as compared to S&P, not surprising. So we're going to use these two as our benchmarks. Now, the first green column to the left is an example momentum system with the standard rule set. In other words, without the optional volatility stop and short positions that we teach, and we're going to look at that coming up in just a second. So here we can see that we have a bit more than double the S&P return, but on the drawdown of the 60/40 buy and hold. So that's more than 3 times the return to drawdown ratio of S&P and almost 6 times the return to drawdown ratio of the 60/40 buy and hold. So here we see our ending balance jumps quite a bit to 838,869. So it's an excellent increase in performance, and we see the difference that that makes to the bottom line. The second green column is the same example momentum system, but now we add the optional volatility stops and short positions that we teach. Here we can see that the total return jumps to 960%. The maximum drawdown is reduced to minus 15.7%. This compounded annual growth rate is 16.4, and we have a return to drawdown ratio of 61.1. So just by adding the optional volatility stop and short positions, we're at roughly 10 times the return to drawdown ratio of S&P and roughly 20 times that of 60/40. The impact on the ending balance is quite significant, and that jumps to 1.14 million. The 3 blue columns are for 3 different configurations of portfolio moving average systems that I've built to meet various objectives. PMA Low, that's the nickname we're giving it here, is a system that I built with the objective of conservative sustainable growth with lower drawdowns. PMA High is a system that I built with the objective of aggressive growth where higher drawdowns are acceptable, and PMA Medium is exactly what it sounds like, medium growth medium drawdowns. So looking at PMA low, we have a compounded annual growth rate of 5.2%. So 5.2%, what does that mean? Does that meet our objective of conservative sustainable growth? Well, here in the US, many financial advisors will tell you to plan on a withdrawal rate of 4% from your account when you're in retirement. I'm not a financial advisor, and that's not advice. I'm just telling you what I read most often here in the US. So 5.2% growth means you can cover your withdrawal rate and still grow your capital. Now, of course, if you're paying a financial advisor, they're going to charge you at least 1%. So here you get to keep that 1% if you're running this system yourself. We see here that also the maximum drawdown is minus 13.6% versus minus 34.7 for the 60-40 benchmark. So we're at roughly 1/3 of the 60-40 benchmark. Fractionally better CAGR than 60-40, but on 1/3 of the drawdown. So we've met our objectives here. We have conservative sustainable growth on a very low drawdown. Mission accomplished. Now, if we did want to compare this to the S&P, we're at about half of the return. So that would be 5.2% for PMA and 9.5% for S&P, but on only 1/4 of the drawdown, which is why this version of the PMA system has a return to drawdown that's roughly 40% better than SPY. Here we're at 8.9, SPY is at 6.2. Now let's jump to PMA high, and here we see that the compounded annual growth rate is 16%, and SPY has a CAGR of 9.5%. SPY has an ending balance of approximately 427,000, and this configuration of PMA has an ending balance of over 1 million. So we definitely met our objective for aggressive growth, but what about the maximum drawdown? Well, we see that the maximum drawdown for this configuration of PMA is minus 33.5% versus minus 52.3% for S&P. So while we said we were willing to accept higher drawdowns, we actually end up with less of a drawdown than SPY, and interestingly enough, also less than the 60-40 benchmark we were looking at earlier, which was at minus 34.7. So if we wanted to compare this to the 60-40 benchmark, this configuration of PMA has a fractionally smaller drawdown than the 60-40 benchmark, with a total return that's roughly 800% greater. So have we met our objective for this configuration of the system? I would say absolutely, mission accomplished and then some. And I should also clarify while we're here that these versions of the PMA system do not include the volatility stop and shorts. On the column all the way to the right, we have a configuration of the hybrid system. The hybrid system combines both momentum and PMA concepts into a single meta system. The advantage here is that the strengths and weaknesses of each method of analysis tend to balance each other out, and we get a diversification of systems all within the same system, within the same portfolio. And again, the hybrid system is just as flexible and customizable as the other two. So what we're looking at here is only one example of what you might build for yourself. This particular configuration, this one that we're looking at here, is personally my favorite configuration of the hybrid system, and it's the one that I'm using in my son's college tuition account. Here we have a total return of 644.3, a maximum drawdown of minus 14.1, we have a CAGR of 13.7, a return to drawdown ratio of 45.77, and an ending balance of 780,130. So in closing, I want to say again that the systems we're looking at here are examples of configurations of monthly asset allocation systems that I personally trade, but they are by no means the only configurations of these systems and are certainly not the only results that are possible. You can learn more about these systems and learn how to customize your own configuration by visiting us at our website, which is www.appliedfinanceresearch.com, or by clicking on the links below this video. Thank you very much for watching, and happy investing.